We're excited to have everyone here today. We have John Lettera, the CEO of RealFi Home Funding. We have Charles Ruffin, who is a senior business developer at Axos Bank. Axos has 14 billion AUM, and they're very active in the commercial space. We have Evan Connolly, who is CEO of Palm Beach AMC. They are a national AMC, and they work with over 10,000 appraisers nationwide. So the topic of today's webinar is challenges in today's real estate market, and we basically just wanted to initiate a candid dialogue about real world problems and issues that we face as lenders, as appraisers in the industry today, and just offer up not only issues but potential solutions to those issues. So with that being said, I'd like to start with John. So John, what challenges do you face today as a lender?
Wow, it's such a blanket question. Let me see where I can start. So as many of you know, like what's been going on in the industry, a lot of the sectors of the market I feel have changed forever. And Andrew, you and I were just talking a little bit about how some buildings and assets almost become even obsolete, which is leading us now to see more and more assets being repurposed and repositioned, such as hotels that we were just talking about. So for instance, I'll just kind of give you my quick overview of what I see in the market. I was thinking about this before I hopped on, but at RealFi on the private lending side, on the non-agency side, we are not at all, or still remain not bullish on, and I'll just give you the litany of the list real fast, right? Traditional retail, we're not bullish on traditional retail. We still see issues with retail. We see store closings, vacancy are still rising. However, the bright side to that is we've been seeing more and more. In fact, we just closed on something beginning of this week, because what I call my exception to retail now is grocery anchored centers, anything with, believe it or not, I love these dollar stores that are popping up. I think those are fantastic. So retail centers with grocery stores, these dollar stores, any kind of home improvement retailers, medical aspect to it, we'll jump in and we'll do that. We are not bullish at all on urban buildings. If we do look at a building in the city, quite frankly, we will look at that with vastly different outcomes based on location and whether buildings nowadays have flexible layouts with respect to better ventilation systems, flexible floor plans, modern amenities. I want all the touchless systems within a building. That's the only way we're looking at that. Not bullish at all on luxury apartment buildings, luxury apartments, not bullish on hotels. So what do I like? Where do I see some good industry and some good things in the industry, right? Well, we are, and we remain bullish, and we've done a lot of lending this year alone, a lot of loans on industrial properties. The surge in online spending continues to spur tenant demand with industrial properties. And when I say industrial properties, that includes data centers. I love the last mile e-commerce related industry asset, self-storage facilities. And last week alone, we closed on our first studio space to start doing the studio warehousing for streaming videos such as Netflix, Amazon. We're starting to really see a lot of that in the market. And obviously remain very bullish on multifamily properties. We think tenant demand is still increasing. We see rents going back to record levels throughout most of the country. I will say, and not to monopolize the conversation, I'll end with this point, but I will say we are seeing a shift away from the expensive downtown markets and towards smaller, more affordable ones. And I'm not sure if you see it at WeLend, but we're doing a lot more of this type lending in the Sunbelt region of the country, is where we're seeing a lot of this occur. So that's sort of where we are in the market right now. Love to hear what Charles and Evan think.
Charles,
Sure.
feel free to chime
I'm the
in.
AMC guy. I just know that the Sun Belt is the fastest growing, the South and the Southwest is the fastest growing region in the country, and we're very busy there. So I can, I can concur with that. But as far as lending goes, I'm the AMC guy. So, and we're mostly residential.
Sure, I can step in and give you my viewpoint. So overall, you have to look at, with Axos, where we are in the market compared to other lenders. So pretty much we're an alternative lender. We look at a lot of transactions that other banks might have passed on. So I'm not necessarily concentrating on clients or deals in which I have a borrower, pretty much a perfect borrower, great property, boatload of properties to drop in my lap for future financing. And with that, that type of client wants the lowest rates and the highest leverage. Our platform is based upon basically storytelling. So there's some reason why you're going to come to Axos. That could be an issue with the unfavorable property type, like hotels, like currently in the market. It could be an issue of a foreign national or a borrower with maybe a past bankruptcy, foreclosure, modification. As a bank, we can look at a wide variety of alternatives. And with that, we look at situations in which other lenders might not consider. So as far as what we're doing in financing, it's a nationwide platform from the West Coast to the East Coast, but in major metropolitan markets. So today I'm doing a lot of actual hotel financing, ground up hotel financing. We can do bridge loans for hotels as well, and perm financing, stabilized and non-stabilized properties as far as with hotels, but dealing with multifamily, mixed use, industrial warehouse. That's a great asset class. A lot of times I get beat out on those particular deals if it's a plain vanilla scenario. So we look for those scenarios in which we can add value. And since we're a bank and my cost of capital is cheap, I look at these different scenarios at rates starting off in the fours. So as far as issues in which we do see like in the market, and pretty much a lot of other individuals as well too, depending on where you're located, like in the Metro New York market and Hamptons, it's like a delay what we've seen for appraisals coming in and things of that nature. Other areas where we live, like certain parts of the West Coast and the South, it's a quicker time period with the appraisal. Like I'm doing basically a property in the Hamptons now, single family investment, and the quote was 4 weeks just to get the appraisal back in the Hamptons. In the city, is better than that, but not too much better. But if you go to some other places, other states, major metropolitan markets, you can get it back much quicker. So it kind of depends on the location where we are considering the request and things of that nature. But a good example, I'm working on a construction of a ground up hotel deal, Salt Lake City. So that one's been put on hold in a sense because the individual borrower, he's having a hard time dealing with the contractors regarding getting quotes because the cost of the supplies is skyrocketing. So there are different parts of the deal that have to be finalized as far as these quotes for materials and things of that nature before we can kind of go forward. So the borrower's like, okay, we still want to go forward with the transaction. This is like ground up construction financing for hotel, but I have to get this part of the deal straightened out. So it kind of depends on the scenario, the location, the asset class, and things of that nature. So we're dealing with these particular restraints in the market, supply chain, things of that nature, plus the appraisals. But overall, we're still pretty active, even though we are dealing with these particular circumstances currently.
Yeah, I think that's a great point, Charles, or several great points. And I'll just kind of use your comments on the appraisal issues that you're facing to just shift gears to that focus for the time being. So we find that today when a deal comes in and it's signed up, the key focus at the initial stages is just ordering the appraisal, making sure that they're getting out to do the inspection. It's almost like the transaction is focused so much around the appraisal process because of the potential delays involved. So with that being said, Evan, like what issues are you seeing on the grounds with your appraisers? Like, do you see a shortage? Like, just be our eyes and ears for us.
Sure. Turn times increasing is legit in most markets. And you said shortage. the statistics say that there is an appraisal decline in population. And I can throw some statistics in so you understand that and explain why it's happening and what's being done about it. But to address this particular issue, this is volume and market driven, right? I was saying to someone, raise your hand if you feel guilty in our industry that so many people were out of work in the beginning of the pandemic, and our phones are ringing off the hook because of rates, right? So the volume right now, because of purchases, because of refis, is in certain markets causing the delay. In 2018, 2019, you could turn an appraisal. In New Jersey, we were turning it in 5 days, right? In Texas, California, it's 5 to 7, tops 10 days to turn an appraisal. Now, fast forward to 2020, 2021, you can still turn something in 7 to 10 days in New Jersey, but Texas, if you're in the Houston market or the El Paso market, you're talking 3 to 4 weeks. And Maine and Colorado, those are tough markets. And those are markets where there are not a lot of appraisers. So that's both appraiser population and volume driven. The issue more today is volume of loans coming through. And our phones are ringing. We're blessed because the phones are ringing off the hook if you're a loan officer or you're a broker. The statistics do say, though, that the appraiser population is declining, right? And there's reasons for that. So in 2013, there were 89,000 appraisers. 2021, there's 78,000 appraisers. 12% decline in 8 years, right? And that's accelerating. And it's accelerating because 50% of appraisers are over 50 years old, 10% are over 66 years old. So the major governing bodies for appraisals are taking action now because of this. So they are the Appraisal Foundation, which is a government organization that oversees the appraisal, every single state's appraisal regulatory board. The other one is the Appraisal Institute, which is made up of, it's like the NBA, right? It's made up of every appraiser in the country. They join this institute. So they've recognized that there's a shortage. There's also a tremendous diversity shortage. So they have programs in place. The reason it's hard to get new appraisers is the barrier to entry is very challenging for someone to want to do, right? You're a young person, you want to get into the industry, you've got to take, it's the better part of 2 years before you have a license. You're taking 80 hours worth of courseware, you're taking 4 tests, then you're working between 1,500 and 3,000 hours, depending on the state, as an apprentice under a real appraiser. People could be willing to do that, but the appraisers aren't willing to do that because they'll spend time on someone, they'll lose that appraiser, or they'll get a real winner, they'll hire them, and then that person might leave in a year and start their own business. So there's
that's after 4 years of college, right?
No, that was true, John, but they've changed that. So you don't need a college degree in order to become an appraiser now. That's a recent change within the past few years, which is a good change. So the Appraisal Foundation, again, which was started from the government, has something called PARIA, practical applications for real estate appraisal service professions. And they are using innovation to change the criteria to become an appraiser. A lot of it is virtually driven. A lot of it is online testing, a lot of it is technology. You're not spending 2,000 hours in the field, but you're spending some time in the field. And they're marketing it to colleges. Some colleges they have that are actually teaching appraisal courses. Again, you don't need a college education to become an appraiser. The Appraisal Foundation also has a partnership. So the Appraisal Institute is the national one, it's the biggest appraiser national organization. They have got initiatives too. So they have diversity initiatives, they have recruiting in high school and college initiatives. So they've recognized this. And I guess they recognized it on time because the appraiser industry, I guess, population is declining, but we're not seeing, dramatic decreases in turn times based on the population right now, except in those certain markets that I mentioned, the Colorados, the Maines, the Texas. So things are turning for the better, and it's a desirable job for young people. You write your own hours. You have a lot of freedom. So you should hear some encouraging things coming from the market.
Hey, Evan, quick question. I know in the height of COVID in March, I think it was 2020, that if I'm not mistaken, I remember reading something that the Federal Housing Authority eased all the standard on the appraisals, and they were allowing the drive-by desktop valuations. And do you still see that occurring, or is it back to the stringent standards?
No, so you're absolutely right. That's a great question. So in March 2020, the FHFA instituted that you could do desktop drive-by appraisals. And last week in San Diego, last week the NBA National Conference. So Sandra Thompson is the director of the FHFA. She made an announcement to rousing applause that she's going to reinstate. They ended it. They're going to reinstitute desktop appraisals. But what she's really talking about there is in rural locations. So she's talking about the appraiser who wakes up in the morning, leaves the home office, drives to Timbuktu and reviews a property, inspects it, then drives to East Jabib and reviews a property, and then gets home at 8 o'clock at night and is supposed to sit down and do their desk work. So that was the main focus of what she's talking about, is easing those restrictions on those type of rural properties. Whether we'll go into the overall market is still a big question. And quite frankly, if I was buying a house, I do want the appraiser to do with the inspection. Right. So for the large part, that should help in some markets, and she has just reinstituted it.
It's almost like I mean, just to comment on your point that you want a real person to go to the house and physically inspect it. I mean, I feel like that would lead to a whole host of issues of just by doing and allowing drive-bys that people like first-time home buyers or unsuspecting may not know, but they might have an issue with the boiler or like some other like utility in the home, which wouldn't necessarily come up in the inspection because the inspector didn't physically go to the premises.
Exactly. This is an anecdote, but I was talking to one of my loan officers about this recently, one of my customers about this recently. Say your brother or sister comes in and they want to borrow some money to buy their first house. She says, all right, I'm going to put 20% down, put 60,000 down. Can I borrow $240,000 from you? And you say, yeah, sure, I have the money. I'll lend you 240. And she says, oh, I'm going to pay you every month. I'll pay you with interest every month. And he says, and you say, can I go see the property with you? And she says, no, don't worry about seeing the property. It's not a big deal. You don't have to see it. And then she says, well, you say, was it an inspector or is the appraiser going to see it? No, it's all going to be done on desktop. Don't worry about a thing. It's fine. You're not going to give her your money. So that's an issue. And that's how an underwriter thinks, right? That's not how a broker thinks. And I love brokers and they give us a lot of business. And I love LOs. They give us a lot of business. But it's someone else's money. And you want to close a deal. You want the deal to go through. But if you need to think a little bit like the underwriter, who's really thinking like it's my money. In the same token, the appraiser who appraises the property is thinking, I've got to get this, I've got to do this job right. Believe me, appraisers are just like us. They want a new home buyer to get into that house. They want the seller to sell the house. They want the real estate agent to make their commission and the LO to make their commission, right? They want to keep their license. So they're going to do what they can to make things work so that deal can close within the parameters that they have. But if an appraiser gets on a chase, you sell a loan to Chase or Wells, an appraiser gets on a Chase or Wells do not use list, that's the scarlet letter. I mean, they're going to lose money for a couple of years, and it's a real tough issue for them. So as much as the appraiser wants it to work too, they're kind of bound by the regulations that are in place. And they're kind of thinking like the LO and the underwriter combined.
Yeah, if I could just add a comment to Charles's point, as bridge lenders, I'm listening to you, and obviously, as Charles alluded to, we're value add lenders, where there's always a story, special circumstance, something. So when the desktop appraisals and the drive-bys were occurring, again, I mean, we saw a tremendous opportunity to jump in when a lot of banks were actually jumping out, because we have the wherewithal, since we balance sheet the majority of our loans, to just lower the LTVs and to juice up the yield a little bit and take that additional risk of not actually seeing the inside or having the full blown appraisal. Number one. Number two, and again, I'm coming at this more in the private lending world, not from the banking world, but the other luxury, I think bridge lenders, and I know We Lend and Access has the same luxury. Oftentimes we can close without an appraisal. Obviously, we're still going to send one of our guys there, look at the property, walk the property, close the transaction, and then wait for the appraisal. So those are sort of just two ways that I know, at least during COVID, and even while the shortage remains, that we were getting around the whole appraisal shortage.
Yeah, and I think another strategy is just to order a rush appraisal and then wait for the verbal. So you figure that'll take 3 to 5 days, and then close, and then just get the appraisal report afterwards. But obviously, you don't only want to do that with a trusted appraiser that you've worked with a lot of times in the past.
Well,
So
quick point from Axel's point of view. I wish I could close without an appraisal. That would be that would be like someone in my positions. I would like the ultimate dream, but I have to have an appraisal every time I do a closing. But one way we kind of get around it, because like I mentioned, a lot of times the deals we've seen have been maybe turned down by other banks. We can actually use an appraisal from another bank or credit union, or sometimes a mortgage banking entity. And as long as it's within like a 6-month time period, and if we have that, that really cuts down the delay of closing a transaction. You can get it closed in like 2 to 3 weeks, ballpark. So that's like another way during this whole issue of time delays, dealing with receiving an appraisal. We try and make it convenient or easy for a client or mortgage broker or professional to use an existing appraisal. We'll still review it and things of that nature, make sure we're comfortable with it, but that can be done as well.
that's a really good point.
I have a question. I'm sorry, go ahead, Andrew.
So just shift gears. So I think that like one of the most prevalent issues that we're facing right now is just the supply chain issues, which is just leading to the cost of building materials to go up, and it's kind of just affecting the industry in a number of ways. So I kind of just wanted everyone's input on that. Charles, if you'd like to start.
Sure. Like I mentioned earlier, so really where I see that being more of an issue is on construction requests, because we do a lot of ground up construction. Typically, for hotels, we're at 50% loan to cost. For other property types, 55, but we do allow mezz and pref equity to bring that up to around 80 loan to cost. But the whole issue there is that budget and what that particular individual sponsor thinks that the cost will be. So they have that in the beginning, but what we see at different times, that budget just being blown out of the water by the rising increase in supplies and the whole issue of labor as well too. So that's where I usually see, more recently over the last, 6 or 7 months, see that particular being in the forefront on the construction area. The other area in which we're in, as far as permanent financing and bridge loans and things of that nature, a lot of times we're not really as much into the value add space. So the whole issue of the supplies and things of that nature needed to, reposition a property, whatever, that isn't necessarily a bigger issue because the properties are typically in decent condition, or it might be a lease up play or something of that nature. So really is more what we see that on the construction side versus some of the other perm bridge scenarios with the bank.
Sure. John, what are your thoughts on the supply chain issues, the lack of construction labor that's out there in the fields?
I think Charles summed it up brilliantly. The one thing that I would add is from a lender's perspective, when we're on these new construction, and we're on a ton of new construction projects right now, a typical investment or a typical loan for us would be a 12 to 18 month maturity. But because of all the bottlenecks and everything that's occurring, we're seeing those maturities go to 24, even 36 months out. So we're taking that all into account when we do our disbursements, our allocations, and our extension fees, obviously. And the last aspect is also where we're assisting the sponsors and the builders in making sure their projections are accurate. So you're not going to get a building done in New York or New Jersey or even Connecticut any longer in 12 to 18 months. You're not getting CO'd in 24 months, and just because of everything that's going on.
Yeah, John brought up an excellent point too. As far as our lending on the construction side, another aspect that makes us kind of unique is we will provide financing to stalled construction projects. Because certain times a lender might be more or less at a point where that particular project has run over budget, and they're like, well, you burnt through the time period in which this loan should have been, wrapped up. So depending on the scenario, we will be willing to step into a project that has stalled, assuming it fits our leverage requirement. And sometimes that particular client might have to put, more equity into the deal. But I think that's very unusual for a bank being able to step into a transaction of a stalled construction project. And typically our rates are usually in the mid fives for construction financing. So it makes it very appealing for those scenarios in which we have a sponsor that has a lot of equity or have the ability to maybe pay down the loan sum to move that project to fruition.
Yeah, I'll add one more comment also, Andrew, that we've seen that really is helping sponsors. Obviously, as private lenders, when someone puts in a disbursement request, we're out there the same day, and we usually have funds to that sponsor or to that borrower the same day. So once you get all of your laborers paid within 24 hours, everything starts to really run a lot more fluidly after that. So we've had great success doing that.
That's a huge benefit. I mean, just because draws can take a lot longer with other institutions. So I think just regarding the issues surrounding construction, right? There's shortage of labor. There's increasing supplies, price of supplies. And then there's a tightening finance market as well, just because most lenders aren't, especially depending on the asset type, on certain assets, pools of capital have dried up for construction. So namely retail, like retail construction financing is it's a lot more difficult to come by today, maybe with the exception of like triple net assets that are have guaranteed leases from McDonald's or another corporation like that. But what issues are you guys seeing on the ground from your borrowers?
Well, as far as, like we're referring to like construction, and if it's like on retail or something of that nature. So I think it depends on the institution, the lender, it depends on the location, because as far as liquidity and construction financing overall, a lot of places in the United States, a lot of local banks are very active in construction financing, especially if you have a solid property and a solid sponsor with the liquidity, PFS, and the track record. You will see, even on retail property types, you will see local banks going in to provide the financing that might not be as high as leverage as you're going to find for multifamily or like an investment warehouse property type. But the point dealing with the banks is a very competitive market out there. So much liquidity from like with John's entity, like private lenders, non-bank lenders, and it's hard to get a deal in which a lot of banks feel comfortable with. So when you do have entities that fit the requirement for construction financing, like I mentioned, great property as far as what they're building, it makes sense, strong sponsor, they have a track record, you do see banks providing construction financing. And so I think it's plentiful depending on if you have the right deal or not. If you have the wrong deal, you're gonna always have a problem receiving construction financing, no matter which type of market you're in, because construction financing is the hardest type of financing to receive. So many pitfalls associated with it. But I see broadly a lot of the local banks, especially in great areas, major metropolitan markets, being open to construction if it fits their parameters.
Yeah, if I could just add to Charles's point, is what does every developer and every sponsor want? They want more money. So the higher you could come in on that LTV, that's your competitive advantage. When I'm looking at a construction deal and I'm talking to the sponsors, very rarely is a sponsor coming back to me and saying your rate is too high. Usually what they're coming back to me and saying is your LTV is too low and we want a higher LTV. So cash is king when it comes to new construction. And one of the things we were very successful in doing is over the last couple of months, we did a deal, and just to use it as an example, we closed $70 million or around 70 million just in Paterson, New Jersey alone on new development. And the reason we were successful is we were able to give the developer 100% of the development cost, only because we cross-collateralized with stabilized operating buildings free and clear that he already owned. So these are just some of the ways that you can get more entrepreneurial and more creative in order to get more money in the developer's hand, or said a different way, less money out of the developer's pocket.
That's a very good point. That's very creative. So how we kind of deal with that particular burden of wanting, as far as from the sponsor, a higher loan to cost on construction, because we're at 55, like I mentioned, unless it's for a hotel, we're at 50, the market easy 60, 65, some places 70, depending on the market where you're at. We do allow mezzanine and pref equity to come behind more or less our particular first mortgage. So there, the bank has a comfort level being in a safe position, 50, 55. Then we also allow that particular client to, have that additional leverage. Now, I see that more applicable on property types, like we're talking about hotel financing. If it's multifamily, you can easily find entities in local banks, 65, some even 70, some of these debt funds, 80, 85, and things of that nature. But how we kind of compensate for our lower loan to cost is usually by pref or mezzanine with the first what we have.
And Charles, if you don't mind me asking, do you supply the entire capital stack, or do you go to third parties to bring in the mezz and the pref?
I wish I could. We're not that. We haven't gone to that extent yet, but usually it's the intermediary, the broker. So they'll have a contact, or sometimes it's a client themselves and with some entity they've worked with, and then they'll bring like that mezz or pref equity entity into the deal, and we'll check them out, make sure we're comfortable with them. But usually, as long as they have a standard track record, we'll be fine with that. But no, we don't typically bring them to the table. It's usually the capital advisor, mortgage broker who usually provides them.
So on our end, our position is that we don't like anyone behind us. Just in the event that the deal goes bad, we don't want to have to get into a fight with a mezz lender or a pref investor. So we only do first. We don't allow anyone behind us. Shifting gears. So I'd like to kind of just circle back to Evan's expertise on the appraisal process. So Evan, with the issues that we're facing today in terms of there being an insufficient supply of appraisers for the volume of appraisals that's out there, what sort of solutions would you have to offer to alleviate this bottleneck?
Well, I would say that it's mostly in certain markets and it's mostly volume driven, Andrew. But one of the things that is causing pressure on appraisers is that the rules, when we had normal volume, right? And we all have to agree, volume in residential has increased dramatically. Refis have increased dramatically since these rates came down. Brokers and LOs are saying, hey, we can close in 20 days, we can close in 30 days. And you're not necessarily factoring in if you're in El Paso, Texas, if you're in Waterbury, Connecticut, that's going to be a 3-week turn on the appraisal alone, or you're going to pay an exorbitant amount of it because of inventory, right? So I think that more of transparency in what's realistic in certain markets. Now, again, if you're in New Jersey, if you're in certain markets in Florida, you can turn in 6-7 days. Others neighborhoods in Florida, depending on the zip code, it's 3 weeks, right? So um, again, it's like market driven, the volume in that market, which can change, from month to month. And it's what you're promising your customers, right? And I don't want to say as an AMC, oh, we can't get that done in 7 days. It's going to take 2.5 weeks. But what we do and what our customers appreciate is we give you the information. We tell you exactly what's happening, what's possible. We'll say, yeah, we can get this appraisal done in 8 days. It's going to be $1,200. If you can wait 14 days, it's going to be $600. So people appreciate that choice, depending how fast someone wants to get into that home or want to close the deal. So that's one thing that could alleviate pressure. Rates next year, let's see what happens. Home prices are supposed to increase according to Goldman Sachs and everybody else. Housing starts are up, but inventory is still probably going to be low. So we'll see. It's really market and volume driven.
Sure. So do you have any particular suggestions as to the technology that could be implemented or other measures that AMCs could implement in order to speed up the process?
Great question. So there has been a lot of efforts to create a technology that could solve this problem. Right? Google invested, $40 million in a company. It's still a private company that was hopefully going to help change the market. So appraisals would still do the appraisal, but they do it at their desk and use virtual tools. It's incapable of accomplishing that without the real home inspection. So that didn't take off. And there's been other companies that have been trying to do it. It's a massive market, right? So there's technology tools, there's AVMs, but there's nothing that's really going to change the supply-demand issue in certain markets while they're still required to do a physical appraisal. I don't see the physical appraisal changing very soon. John mentioned earlier what the FHFA said, and again, I think that applies to rural areas and low-income families more than the general market. So there's not a technology right now. I mean, we have our technology that texts appraisers in their field rather than having to wait until they get home and read their email and get up on status. We're in touch with them constantly, every day. We work with these appraisers day in, day out, 6-7 days a week for the last 2 years. They're working that hard. But there isn't anything right now that's going to change the game dramatically, except increasing appraisers in certain markets. I mean, if you want to be busy and you want a job, go to Colorado and become an appraiser. Go up to Maine and become an appraiser. I mean, you're going to have as much work as you could possibly want.
I'll stick to the private lending business, but thanks for the offer. So you had mentioned earlier that one of the factors that's relevant, which I entirely agree, is the potential for rising interest rates in the coming years. So John, to throw it over to you, how do you think interest rates, the potential of interest rates rising, will affect the market?
Yeah, it's a good question. I think depends on which market we're talking about. And I say that because very oftentimes you're looking at it from a buyer's market, a seller's market, a private lender's market, a banker's market as compared to a private lender's market. So I think generally speaking, we need to start by looking at the broader macroeconomic trends and how those translate into physical real estate along with the interest rates rising. So I could just talk about it from a private lending standpoint, which is sort of my specialty. And obviously, the Fed has often come out and said it's going to be a low interest rate market from here on in. We've seen that. But if the rates are, and we've seen them tick up a bit, and as they continue to tick up, it really helps the private lending market. I mean, that now obviously the spreads are less competitive. More and more sponsors, more and more borrowers tend to flock towards the private lending, not having to deal with the institutions, not wanting to go through what an institutional bank will obviously make them go through in an effort to get that loan. I think, in addition to just interest rates and what interest rates do to the market, you have to ask yourself what will also be the primary economic drivers over the next few decades, and how will those economic drivers impact demand or lack of demand for certain asset types, for certain types of properties. So it's really not just how the interest rates are going to affect our market, but I truly believe it's more or less how the broader macroeconomic trends are affecting all of our markets.
Yeah, it's a great point. I mean, with inflation increasing at the rate at which it is, I think that's more of a concern and more of a driving factor than the potential for interest rates to go up next year, significant 25 basis
100%.
points, let's say.
Yeah.
And I think that just kind of ties into just the overall theme of just like, hey, there's a certain shift in the overall economy right now, which is affecting the real estate market. So namely, with inflation going up and with this supply chain issue that we're facing overall, these are the sorts of factors which are impacting real estate investors. And then we're kind of just seeing the effects from their activities.
Yeah, if you recall, Andrew, you made a great point. If you recall March of 2020, right, the initial expectations of a protracted recession and recovery is going to span several years. Well, that never occurred. In fact, the economy began to bounce back as quickly as it shut down. So the recession ended up, if I'm not mistaken, just based on all of the legal opinions, only lasted about 2 months, which is one of the shortest recessions on record. In fact, economic output, as I'm sure you're reading, it's already back above pre-COVID levels. And jobs, if you read this morning, jobs are expected to recover to the previous levels by the beginning of 2022. So it's a perfect indication of where we are.
Sure.
Entirely. It's kind of, given the strong economic state that we're in, the idea that the federal government would want to issue $3.5 trillion in like so-called like bailout money, which it seems like that there was significant pushback on that number, and it's going to be reduced significantly. But it almost seems like that number should be curtailed significantly to be in line with where the economy is at this point.
Yep, I agree.
So what other high-level issues are you guys facing on the ground? Like, what are you seeing from your investors in terms of the issues that they're facing?
As far as with different individual real estate investors, this one of the hardest ones is trying to find a asset that makes sense regarding the return. So, what we're talking about here is how robust the economy is. So the downside is if you're an investor, or you're a real estate entrepreneur trying to find your next deal, it's so competitive. The prices, depending on where you're at, is, so it doesn't make any sense as far as what return you are trying to achieve. So I think that's one of the bigger issues here, in which you do find these investors running across, is just trying to find a decent deal that makes sense. So investor side, that's one of the issues I've seen, and just working with different investors in general, looking at different setups and analyzing it, and then they go to the next one and things of that nature. Or you might end up in a bidding war for a particular property. So that's one of the main aspects I see associated with such a robust economy.
John, Charles, we see that too in our industry. The bidding wars and it's the inventory issue, I think. So the fix and flip market, there's bidding on new homeowners who want to buy a house, and there's bidding on the fix and flip market. And Redfin came out, I think it was last week. They said the statistics were 75% of purchases were bidding wars in April. It's
Mm.
down now to 59%, but that's still an extreme percent. So from my perspective, in the residential market, it's driving prices higher, and it's harder for the appraiser to find the right comps.
Right.
But the inventory issue is an issue. And I wonder how you guys are dealing with that on your end.
Yeah, well, I could tell you what I think and what I see happening is very interesting. And as I alluded to before, we've seen fund managers of these private equity funds, the aggregators, the hedge funds, they've raised huge amounts of cash in order to pick off what I like to call the predictive wave of distressed notes and foreclosed properties that everybody thought was going to come out of this long stretched recession that we talked about. Obviously, those predictions fell flat. I'd like to say market fundamentals held up very well. So investment cash, both domestic and foreign, it still continues to surge into the US. And why? Because we still have low interest rates, and we still have attractive real estate, at least offers very attractive returns relative to risk. So you have all your institutional investors who need to keep their portfolio of stocks and other assets in balance. They turn to real estate when those values fluctuate and portfolio concentrations get out of whack. So what does that all come down to? Well, it's heightened the interest of these institutional investors to now come in and start picking off single family homes and single family rentals. And it's exacerbating the problem. It's constraining the number of homes that are actually on the market. And I read an article this morning that I'm happy to even share with you later on. It was on realtor.com, which said that investors reduced the for sale inventory by 3/5 in 50 states that they tracked. So you see it happen. And that even took into account what they're calling single purpose build to suit single family homes. So these are all done by institutional investors jumping into the market. Furthermore, the build for rent investors are competing with the for sale developers. They're competing for the lots, the subdivisions, they're driving up land costs. So that's what all your residential developers and your more experienced developers are dealing with right now. And that's what makes it so difficult.
Yeah, and just further on John's point, just dealing with the the global economy we're in. Like, I gave a quote for a foreign national from China that wants to purchase a non-stabilized hotel here in New York City. The hotel price is over $60 million. So we're able to give a quote on that, something we would finance, but that gives you to the extent of how much competition there is domestically and entities abroad who are very interested still in real estate assets in the United States, but more specifically, even New York City, because New York City was hit the hardest during the pandemic, especially with our real estate market. So we do see it on the mend and turning and things of that nature, because even with our products like bridge loan financing, stretch bridge loan financing, we will look at the retail, the office property types, along with like multifamily and mixed use, which is much more competitive. But to that extent, we do see still a lot of competition from domestic and abroad regarding trophy assets here in New York City.
Yeah, I'll take it a step further. And then all of these fund managers, to your point, Charles, that can't find these good deals or these investment properties, what happens? Now, all of a sudden, they want to become lenders. So, I like to say, when I started in the hard money private lending business, which was 30 years ago, I put money out at 16-4. I don't care where you were, it's 16-4, no competition. So fast forward, that 16 went to 14, went to 12, went to 10. Now I'm competing at like 5-6%. If you would have told me when I was doing deals at 16% that I would ever be looking at a hard money deal at even 7%, I would have walked away. And we're seeing it on both sides, whether it's on the sponsor development side, but even as lenders, we're seeing the same amount of competition.
Yeah, a lot of competition.
I think you guys raised several great points, but no, I think that's an issue that we see from our investors, like literally on a daily basis. It's a running joke in our office where, like, hey, you got any deals? Like, nope, no deals. Like, it's just everyone's looking for like some sort of distressed asset to acquire, and just there don't really seem to be many. I guess we feel that once the foreclosure auctions start to not only open up but to really like gain momentum, then there should be more distressed assets across various asset types. Um, I don't think it'll be a huge uptick or huge wave that we should all be preparing for, but at the same time, we are hoping that there's going to be more inventory, one, and that deal flow will pick up because of these new opportunities that come about. Um, so, uh, Evan, um, what are you seeing on the ground from in terms of like these bidding wars and like the time constraints that are placed on appraisers?
These bidding wars are great for the sellers. You're selling your house, it's terrific. It's a pain in the neck for the borrower, for the lender, and for the appraiser. So just this week, this week, I won't mention my customer, but president of a lender's daughter was buying a property and the contract price was $249. And I mean, the listing price was $249. The sales price was $279, $280, right? So my appraiser, that's a bidding war. It's a significant percentage over what the asking price was. So people were bidding that price up and it was worth it to her to purchase that. So my appraisers have to find comps within half a mile, or they have to look for a mile, or they have to go a mile and a half out, and they have to go 3 or 4 miles out. So they got to find something that's going to make that deal work. Market value in most markets, as we all know, the stock market is what someone is willing to pay for that asset. That's what the market value is. At the end of the day, a stock can go like this. End of the day, whatever that stock closes, that's the value of that stock. That's not in the housing market. There's the appraised value, and it has to be based on what else is sold. You got to compare it to other things. In the stock market, you don't compare, Apple to its peers, peer companies' price earnings ratio. You just buy what the price is. The housing market's different because it's not your own money; it's a third party's money. So you've got to find the challenges finding these things that make this a fair deal to the lender. The underwriters are gonna put through, and the bidding war is a challenge for appraisers. Again, appraisers want to make it work, but they have to stay within these parameters to make it work. And the bidding wars have been painful for that side. The seller is hey, if you're selling your house, it's great. But the buyers, the appraisers, the lenders, it's a bit of a challenge. I hope that answers the question. So anyway, it looks like the loan's going to close for my client's daughter. So that's good news. But the appraiser was struggling, and it was unable to make the exact value. I'm sorry to say. I think 80% of appraisals make value. This is one of them that didn't. But the deal was still close.
I'm sorry, you said it did not make value.
It didn't make the 30,000 over asking price because there were no comps that could support it, even with making adjustments to those comps. It didn't make the 380.
Got it. So in a situation like that, the sponsor would just come up with more equity.
Exactly.
Shield the difference.
Exactly. And that's what happened. So, and that protects the lender. But it's, the inventory issue is real, and that's what's driving, and the bidding is what's driving up prices, and it's a challenge for the appraisers and the lenders.
Yeah, I mean that story just sounds like so familiar. I feel like it's like so typical for like, oh, these people got in a bidding war for this house and they went 30,000, 50,000 over, 100,000 over. And someone swooped in later and put a higher bid in.
Crazy.
Yeah,
and if you're a seller, it's great.
Yeah, exactly. If you own assets, it's amazing. And then you can refi and pull out money based on these higher values. So there's a number of advantages to holding on to assets right now, which is why the market's so competitive, both foreign and domestic, to acquire these assets, and it helps explain the the compression in cap rates that we're seeing. Does anyone have any sort of last minute thoughts or comments that they'd like to add before we start to wrap up? Charles, John?
Well, yeah, it's wrapping up. It's a great discussion we're having here because, the main thing is, even though we have all these disruptions or issues associated with what's going on now within our line of work, the great thing is we are able to work. So the market is busy. We're keeping busy. It might be harder to find transactions here or there, but we are still in a great position in the economy to help our clients, to help our company, and to move forward with the mission of what we're trying to do, accomplish our overall goal in general for ourselves and for our employers, or just for our own businesses themselves. So we do have difficulties, but it's a great time to be in our market.
Yeah, it's a good point, Charles. I always like to say that a lot of these disruptions and challenges always relate to new opportunities. Right. And as long as your company, yourself, your sponsors, everyone could remain fluid and remain able to pivot, that there's always opportunities. Like even a lot of the challenges that we heard about today, at least for us, created opportunities for us. For instance, instead of trying to get distressed properties, we'll get into different levels of the capital stack and hope for maybe a distressed situation like that. So whereas we were predominantly senior private lenders, we're now taking mezz positions, pref positions. So just different avenues of opportunity that we now see. And again, I just think that a lot of these challenges create new ways and new opportunities.
That sounds great, John. I'll follow up with you on the mezz and pref. Maybe I can connect you to some of my brokers, and there might be another way for us to work together.
That'd be great. We'd love it. Thank you.
Yeah, definitely.
No, I think that,
now we got to include WeLand on everything.
Well, I said earlier, access is our bank. I'll go a little more macro, Andrew. And it's a plea or a challenge to some of the people in the audience. America is the biggest economy in the world still. Real estate is the biggest market segment in America. It makes up for 13% of GDP. If you put the mortgage and home insurance industry in that, it's 20% of GDP. You know what healthcare is? 7%. So we're the biggest industry in the world. And I think that, even with the appraisal thing and recruiting and getting the government, the Appraisal Foundation run by the government, to recruit new appraisers and to make change. I think some of the leaders in the mortgage and real estate industry, some of the high-level leaders at MBA or the biggest companies, push for change in government, in Congress. And government moves so slowly. Thankfully for my appraisal industry, they've made changes that look like to be fast enough to create diversity in the industry and get young blood into the industry, right? As people in the appraisal industry are approaching retirement age. But it's got to come from people making an effort, spending some time to do that. We're the biggest industry in the world. That means biggest in America, biggest in the world. Some of the leaders step up and do that. So that's my that's my closing statement.
Yeah, no, I love the positive spin that everyone's putting on things, that even though there are these challenges and issues that we're facing in today's real estate market, that we're in a great time for not only to own real estate, but to lend on real estate. And there's tremendous opportunity out there, really for everyone in our industry. So I think with that being said, I'd like to thank everyone. I'd like to thank John Lettera from RealFi, Charles Ruffin from Axos Bank, and Evan Connolly from Palm Beach AMC. Really appreciate having you guys on. And we look forward to the next webinar.
Thank you so much. Thanks for having me.
Thank you very much. Thanks, Andrew.
Take care.
Thank you, guys.
Gentlemen, nice talking to everybody.